Hi everyone, this is chapter 17, the last chapter that we'll be covering for accounting class. So, without further ado, let's get to it. We're going to start with 17.1, vertical analysis of an income statement. And the goal of this lesson is to analyze an income statement using vertical analysis. A little bit of info to start. Vertical analysis ratios measure the relationship between one financial statement item and another item on the same financial statement. On the income statement, vertical analysis ratios focus on the ability of a business to earn a profit, and a ratio that measures the ability of a business to generate income is called the profitability ratio. Okay, so this is pretty interesting to know, especially for stocks. Vertical analysis is ratios on an income statement and are expenses of profitability ratios. Managers use vertical analysis ratios to help make business decisions. For vertical analysis to be an effective tool, a business must set a target or standard for each ratio, and a benchmark is a standard used to compare financial performance. Factors used to determine benchmark ratios are actual ratios from prior fiscal periods, industry standards published by industry organizations, business plans, and unexpected events. COVID was a very unexpected event. Analyzing trends with vertical analysis. Financial statements that provide information for multiple fiscal periods are called comparative financial statements. An analysis of changes over time is called trend analysis. Net income after federal income tax as a percent of net sales is called profit margin. This is an example of analyzing trends with a vertical analysis. Okay, so you could see the percents on the right-hand side of the current year and the prior year. Gross profit as a percent of net sales is called gross margin. This ratio is also called gross profit margin. Okay, so you could see the gross profit percent over there. For the current year is 58.8, and for the prior year it was 60.9. Correcting an unfavorable gross margin, increase unit sales prices, decrease the unit cost of merchandise. Using vertical analysis to analyze operating expenses. Operating margin is income from operations as a percent of net sales, and it's also called the rate of return on sales. Operating expense ratio is total operating expenses as a percent of net sales. Correcting an unfavorable operating expense ratio, you would reduce operating expenses, modify the benchmark, and increase the net sales. That's it for 17.1, so now we're on to the questions. Identify 4 factors that management can use to determine benchmark financial ratios. First, actual ratios from prior fiscal periods. Second, industry standards published by industry organizations. Third, business plans. Fourth, unexpected events like COVID. Second one, why should a business be cautious about increasing the markup on merchandise purchased for sale? If the increase in markup is too large, a decrease in sale revenue could occur for 2 reasons. First, the sales price may exceed what customers are willing to pay, or second, customers may elect to purchase from competing businesses that have lower prices. Third, what are 2 practices that can be used to reduce the cost of merchandise? Purchase merchandise in larger quantities or from other vendors that offer a lower cost. Should managers interested in reducing operating expenses focus more on the operating expense ratio or the operating margin? They should focus more on the operating expense ratio. A lot of questions today. Fifth, what are 3 possible actions to correct an unfavorable operating expense ratio? Reduce operating expenses, modify the benchmark, increase net sales. Now we're on 17.2, which is vertical analysis of a balance sheet. Goals of the lesson are to perform vertical analysis of a balance sheet and to analyze a balance sheet using vertical analysis. Calculating vertical analysis ratios on a balance sheet. The asset amounts divided by total assets. Liability and stockholders' equity amounts divided by total assets. Evaluating vertical analysis asset ratios. Here's an example of the different percentages. Vocabulary. Solvency ratio is a ratio that measures the ability of a business to pay its long-term liabilities. Debt ratio is total liabilities divided by total assets. Evaluating vertical analysis liability ratios. Okay, so you can see again by the percentages. So that's about it for the second section. Questions now. Why do many retailers perform vertical analysis on the accounts receivable and merchandise inventory accounts? First, these are typically two of the largest asset accounts for a retail merchandising business. Second, industry standards are available for these accounts. Second question, what may cause a vertical analysis ratio for accounts receivable to be below the target range? Answer, a ratio below the target range may indicate that a company is restricting customers' ability to purchase on account. This action may have a negative effect on sales. Third question, what may cause a vertical analysis ratio for merchandise inventory to be below the target range? The business may not be stocking an adequate supply or a variety of merchandise. Fourth question, what should a company do if the vertical analysis ratio for merchandise inventory is above the target range? The company should prepare a list of the inventory items having the largest cost. The company should assess whether the proper quantity of each item is available for sale. Future inventory purchases should ensure that the optimal quantity on hand is maintained. Fifth, why is it risky for a business to have too many liabilities? The business must be able to pay its liabilities on a timely basis. If sales decline during difficult financial times, such as COVID crisis, a business may be unable to make its monthly payments. Now we're on 17.3, horizontal analysis. Okay, so we were talking about vertical analysis, now we're on horizontal analysis. The goals of this lesson are to perform horizontal analysis on an income statement and to perform horizontal analysis on a balance sheet. Analyzing trends with horizontal analysis. Horizontal analysis is a comparison of one item on a financial statement with the same item on a previous period's financial statement. So we have the current period minus the prior period is going to equal either the increase or the decrease. It's a decrease if it's in parentheses. So over here we could tell that there was a $21,095 increase if we subtracted the current period of $242,000 and change minus the prior period of $221,000 and change. Okay, so now what we do is we would divide the increase by the prior period, and we would get our horizontal analysis ratio of 9.5%. Okay, so 21,095 divided by 221,489. It's going to give us our horizontal analysis ratio. Horizontal analysis on a balance sheet. First, there's the current year minus the prior year. Then there's the difference amount divided by the prior year. Okay, so that will give us the percent. That was it for 17.3. How could a 2% decrease in supplies expense be an unfavorable trend? If management took actions that should have decreased supplies expense by significantly or more than 2%, then only a 2% decrease would be unfavorable. How does a publicly held corporation use horizontal analysis when reporting to the Securities and Exchange Commission? The document filed with the Securities and Exchange Commission contains a section titled Management's Discussion and Analysis of Financial Conditions and Results of Operations and Results of Operations. That's a typo that Cengage had. Management often uses these ratios to explain the current year's results of operation compared to previous years. Now we're on 17.4. We're working our way right through this, which is good. This is about analyzing financial statements using financial ratios. What we want to do is calculate the earnings per share, calculate and interpret market ratios, calculate and interpret liquidity ratios. Earnings per share is the net income after federal income tax divided by the number of outstanding shares of stock. So earnings per share. EPS is just the acronym for it. So net income after federal income tax would be, for example, $79,896.57 divided by however many shares you have. So let's say that's 7,500 shares. Divide that all together. The earnings per share would be $10.65. Or if there's 75,000 shares on the right-hand side, that would be $1.07. You have to round up. Market ratios are ratios that measure a corporation's financial performance in relation to the market value of the stock. So that's a pretty good ratio to know. Dividend yield. So stocks that pay dividends have dividend yields, and this is the relationship between dividends per share and market price per share. So for example, dividends per share at $2 divided by the market price per share, that's how much a share costs, at $228 and change, is going to equal a dividend yield of 0.87%. So the higher the dividend yield means the more that customers who own the stock are getting. PE ratio, aka the price earnings ratio, is the relationship between the market value per share and earnings per share of a stock. So for example, the market share of a stock is $228 and change divided by the earnings per share of $10.65 is going to equal a price earnings ratio of 21.5. Liquidity ratio is a ratio that measures the ability of a business to pay its current financial obligations. Okay, so that means how much money it can pay for its bills right away. How liquid it is, how easily it is to take assets and turn them into cash. Working capital is the amount of current assets minus current liabilities. So for example, if current assets were $185,000 and change, minus the current liabilities of $32,000, they'd be at about $153,000 in change for their working capital, how much money they have to work with. Now we're on current ratio. There are a lot of ratios in this chapter, especially in this section. They're good to know, especially for the future, in case you're interested in stocks especially. And if you have any questions about this, feel free to let me know. So current ratio is a ratio that measures the relationship of current assets to current liabilities. The current ratio measures a company's ability to pay its current liabilities when due. So for example, if the current assets were $185,000 and change, and its current liabilities were $32,000 and change, you would divide the assets of $185,000 divided by $32,000, and that would give you a current ratio of about 5.75. Quick ratio, also called, quick assets, also called liquid assets, are cash and other current assets that can be quickly converted into cash. Okay, so that means how liquid are you? So what are things that can be quickly converted into cash? Things like stocks. Okay. Quick ratio is a ratio that measures the relationship of quick assets to current liabilities. So for example, quick ratio, if you have 54,000 cash plus accounts receivable of 17,000, that's money that's you're waiting on, you're in the area of about 72,000 and change with quick assets. So if you divide your quick assets divided by your current liabilities, so 72,000 and change divided by 32,000 and change, you'd be at the quick ratio of 2.24. End of section 4 of chapter 17. Why can one corporation's earnings per share not be compared to the EPS, earnings per share, of other corporations? And that's because each corporation's EPS is a unique number because corporations can issue any number of shares. As a result, the earnings of each corporation are divided by a different number of shares. What group is the primary user of market ratio? That would be people who invest, investors of the stock market. Third question, do income stocks typically have low or high dividend yields? And that would be high. Okay. Customers are depending and wanting those dividends that the companies dish out. Do growth stocks typically have low or high price earnings ratios? They typically have high price earnings ratios. Why they're called growth stocks. What is the primary source of data to calculate liquidity ratios? And they use the balance sheet for that. Our way right through this, almost there. What does working capital measure? Working capital is a measure of the financial resources available for the daily operations of the business. And this will be our slide. Why is the current ratio a useful measure of financial strength? The current ratio permits a business to compare itself to its industry or to provide a convenient relative measurement from year to year regarding the company's ability to pay current liabilities when due. So that is chapter 17, the last chapter that we'll cover for this class. If you have any questions on this, please feel free to let me know. You can look at the PowerPoints on your own too, but this was just a guide to get you through the PowerPoints. Again, any questions, please let me know. Thanks.